Hello. I'd like to start this third video off with you on page 1215. Okay. One item that I thought was important enough to put on your last exam is the statute of limitations. Okay. The one question that you're going to get from your clients over and over and over again is, how long do I have to hold on to these records? Okay, and it's a common misconception that you have to hold on to them for 7 years. Okay, that isn't true. All right, it tells you in the middle of page 1215. Okay, if you read in the first paragraph underneath statute of limitations, and you get about halfway through the paragraph, it says, in general, the statute of limitations for a tax return runs for 3 years from the date the return was filed or the return due date. Okay, so that means that if you filed your tax return in June of 2018, okay, then the statute of limitations would run out in June of 2021. Okay, all right. If you filed your tax return on or before April 15th, all right, then the due date would be April of 2021. All right, if you are getting a refund, okay, all right. So for example, you know, I had a woman a few years ago who had never heard of the earned income credit. All right, so we amended her last 3 tax returns. Okay, so I'm making this video, okay, in May of 2018. All right. That means that I can go back to the 2014 tax year. I can go back and take a look and go, okay, the 2014 return was due April 15th of 2015. I'm too late. Okay, so the only returns now that can be amended would be the 2015, the 2016, and the 2017 return, which would have been filed this year. Okay, so you've got 3 years, all right, to amend the return. All right, 3 years from the time that you filed it, or 2 years from the date that the taxes were actually paid. Okay, all right. The states have different rules. Indiana, I believe, is on a 2-year cycle. Okay, all right. So, you know, for those of your clients that don't have real estate, okay, you can tell them that hold on to your records for 3 years, and then you can either, you know, make PDF copies of them or just simply shred them. All right, now there are some exceptions. All right, if a fraudulent return was filed, or if no return was filed, there is no statute of limitations. All right. If the taxpayer owes an amount greater than 25% of the gross income on their return, okay, if they omit an amount, all right, of 25% or more of their gross income, so in other words, they filed a return with $100,000 of income on it, and they failed to report $30,000 or 30%. All right, it tells you there the statute of limitations is increased to 6 years. All right, in the case of a bad debt or worthless securities, all right, the statute of limitations is increased to 7 years. Okay, all right, so you might see a question like that on your last test. All right, so let's move along a little bit to the bottom of page 1216. Okay. If you are going to do taxes for a living, okay, there's a part of the page 2 of the 1040 is where you sign off as the paid preparer. All right, you would also sign off on Form 8875, which is the electronic form that accompanies the return. It's actually the signatures on Form 8879 that allow you to electronically file the tax return to the IRS. All right, so the signatures on Form 8879 are the real signatures. All right, not necessarily the one on page 2 of the 1040. The the point I'm trying to make, though, is that if you're going to be paid for preparing people's taxes, all right, you've got to know some of the rules. All right. Number one, in the middle of page 1217, okay, they talk about where you have to have a PTIN, that is a Preparer Taxpayer Identification Number. All right, you have to have that number. All right, you can go to PTIN.org, that's PTIN.org, and apply for a PTIN. All right, you used to have to pay anywhere from $50 to $63 a year, an annual fee for this PTIN, but that was disallowed in 2017, and now they are free. But you still have to have one. Okay, you cannot electronically file a tax return unless you have this PTIN. Okay, now that allows you to prepare and electronically file the returns. Okay, now what happens if you have to represent your client in front of the IRS, whether it's a correspondence audit, an office audit, or a field audit? Okay, well, the IRS breaks down representatives of the taxpayer into two categories. Number one, the enrolled preparers. An enrolled preparer can only fall into one of three categories. They are either a certified public accountant, they are an attorney, or they are an enrolled agent. Okay, they're an enrolled agent. So if you were interested in becoming an enrolled agent, all right, Ivy Tech has an enrolled agent certificate that you can earn here. Okay, and at the completion of this course, you should be able to pass the enrolled agent exam in order to represent your client in front of the IRS. All right, CPAs and attorneys automatically get that right, and enrolled agents earn that right by passing the IRS special examination. Okay, so those three categories are called enrolled preparers. All right, unenrolled preparers would be anybody that isn't a CPA, an attorney, or an enrolled agent, otherwise known as an EA. Okay, at the bottom of page 1217, all right, top of page 1218, you may want to review the penalties that can be assessed against the preparer. All right, for example, $50 for failure to file or failure to sign the return, $50 for failure to give your client a copy of the return. Okay, all right, and you are allowed to give a copy to anybody that is listed on the return as either the taxpayer or the spouse. All right, because those are the two that are signing the return. For example, you know, I get couples that are on the verge of a divorce. They'll come together to sign the return, and then they go their separate ways, and they both ask me for a copy of the return. I have to give both parties a copy of the return. All right, even though one of the two parties may not necessarily want the other party to have one, you have to give both parties a copy of that return, or you are subject to these penalties. And worse, actually. I mean, if they wanted to pursue you in court, so there'd be no reason not to give them a copy. Okay, they talk about the burden of proof on page 1218. It used to be the burden of proof fell on the taxpayer. All right, now the burden of proof is on the IRS. So if you get audited by the IRS, you know, and they say, well, you know, you can't take this deduction or something like that, they have to prove that the deduction that you tried to take is not lawful. All right, so the burden of proof falls on you. All right, a while back, the IRS published a taxpayer bill of rights. All right, you can read those bill of rights on page 1220 and on page 1221. Okay, the last thing that I want to mention for Chapter 12 is something that will be on your last test. All right. One of the important things that you have to know is the difference between the average or effective tax rate and the marginal tax rate. Okay, when you listen to the news all the time, they always talk about, well, somebody's in this tax bracket or that tax bracket. Okay, what they're referring to are the marginal brackets, and those are the tax brackets that we've been referring to all through this course. Okay, all right, the lowest bracket, for 2017, was 10%, then it went to 15, then it went to 25, and so on. Those are the marginal brackets. What that means is that after you have entered all of the income and all of the deductions on a tax return, okay, whatever the next dollar of income is that you put on the return will be taxed at that bracket. So if you're in the 25% tax bracket, okay, that means that the next dollar of income that you put on that return will be assessed a 25% tax rate. Okay, now that doesn't mean that that is the rate you are actually paying on the return. Okay, so what I would like you to do is I want you to go all the way back to our favorite page that we have talked about all semester long, and that is page 2 of the 1040. That is page 2 of the 1040. Okay, so what I want to do is I want to go to line 63. All right, line 63 is your total tax. All right, and we can compare that to line 43, which is your taxable income. Divide the two by each other, and that is your total average tax rate on your tax return. Now, this can be a little misleading because line 57 includes the self-employment tax if you are a sole proprietor and file a Schedule C. Okay, so what a lot of people do is they will look at line 56 and take the amount on line 56 and divide it by the amount on line 43 to get the average or effective tax rate. One of the returns that you had to do for homework in this class was the return for America Los Rios in Chapter 8. In Chapter 8, America had a tax of $11,020. Her taxable income was $64,700. Okay, if you divide those two by each other, America's effective or average tax rate was 17.03%. All right, since that rate falls between the 15% bracket and the 25% bracket, it is said that America is in the 25% marginal tax bracket, but her effective rate is 17.03. All right, when I do a tax return for a client, if they appear to be a little upset with the amount of taxes they're paying, okay, this is what I tell them. I tell them that you're in this marginal bracket. All right, because that amount actually prints out on the tax return that I give them. It's on an information sheet. But then I tell them you're not really paying 25%. You're paying, a percent that is lower than that amount. Okay, so you're going to need to know the average tax rate and or the effective tax rate, and also the marginal tax rate for your last test. That concludes this video for Chapter 12.